The views shared on this podcast are those of Mike Sowers and do not represent those of Commercial Investors Group. The information shared is not investment advice. Please consult your financial, legal, and tax advisors before making an investment decision.
Welcome to Creative Commercial Podcast. We are very excited to introduce Brian Farrell to our show. He is going to talk about thinking outside the box, trusting your gut, don't overanalyze, and be persistent. That's really the themes that you're going to be able to take away from this podcast with Brian Farrell from Northland Real Estate Group. Without further ado, let's get started.
There are two kinds of people in the world. Those that worry sharing their ideas will hinder their success, and those who are driven by the success of others. The first kind view everyone as a competitor. They guard their playbook tight to their chest, rarely collaborate outside their inner circle, and are reluctant to show their cards. Then there are the second kind, the kind who have graduated from the first category. They don't count the number of deals they've done. What counts to them is the number of people they impact and the depth to which they impact them. Achievement is still important to them, but it's subordinated to the depth of their purpose. So they give freely of their time, knowledge, and expertise to build a bridge for those who follow in their footsteps. These are the people who were called to change the world. These are the people who develop people, places, and ideas. And this is the show where they do it, on the Creative Commercial Real Estate Podcast. Hi guys, my name is Mike Sowers and I started Commercial Investors Group in 2005. The company is a development company that also does brokerage, leasing, property management, construction, and professional education. You know, when I got started in this business, nobody would teach me anything. And I got frustrated about that, so I'm doing this channel to bring you step-by-step advice on how to get started in commercial real estate or take your business to the next level. I truly hope that this information blesses your life, and if it does and you find it useful, be sure to subscribe, and you can even click the little alarm symbol and you'll be notified when we post new content. Mike Sowers here with Commercial Investors Group, and I'm really excited to bring you guys an awesome discussion today. I have joining me James Smith from our acquisitions team, and we're going to be interviewing Brian Farrell of Northland Real Estate Group. Thanks for coming on the show today, Brian.
Excited to be here. Thanks for the invite. Feel honored.
Yes. Well, we're honored to have you, and I'm excited to get into it. So I think today's topic was going to be kind of thinking outside the box, trusting your gut, not overanalyzing things, and being persistent. And that's particularly exciting to me because sometimes I get caught in that paralysis analysis, moment and kind of constantly losing sleep over reevaluating deals. So tell me a little bit about your firm and what kinds of projects you guys are doing, and then we can go from there.
My firm, it's a smaller boutique development and investment firm focused here on the Twin Cities. We have looked at other projects around the Midwest, but we have been inundated with cool projects right around here in the Twin Cities, so we haven't really needed to venture too far. We have been doing some historic rehabilitation, mixed-use projects, apartment projects, age-restricted living projects, specifically active adult communities, and continuum care senior housing projects. Been looking for some industrial deals, but haven't been able to make any work yet. So pretty much anything. I'm fortunate enough to have a background where I saw and developed, I guess, my education around all project types, data centers, everything you can think of. So every asset I look at, I can start with a clean slate if I want on truly the highest and best use, which I find kind of liberating to be able to do versus just having one focus like some of the groups out there that I run into.
So let's talk about that a little bit. So you do all asset classes. So tell me about that. So what's your process for actually going through and identifying opportunities?
For me, there has to be some sort of distress. So ground up development gets the returns that I'm after. If there's a management or capital issue, That creates an opportunity if, it's coming from a bank, if it's coming from an architect that hasn't been paid, if it's coming from an individual that had their equity group fall out. There has to be some sort of hair. I'm not the guy that buys a fully stabilized deal at an aggressive cap rate. That's not the money that I play with or the money that follows me. So it just has to have the right opportunity first, and then dive in and make sure that opportunity exists and that everyone is on the same page as far as a structure that could warrant an opportunity like that, and then we go.
Gotcha. How did you get started in this business?
Well, when I was 18, I got my real estate license. Then I started splitting up farm ground and selling building eligibilities, and then that got me intrigued into commercial real estate. And then went to the University of Wisconsin-Madison through their real estate program down there.
Oh, I'm sorry to hear that.
Big golfers here.
Peanut butter and jealous.
All right, fair enough.
So I worked for a developer down there, very creative guy, young guy, aggressive, and got me intrigued in development and opportunistic investing. From there, I went down to Des Moines, Iowa. Principal Real Estate Investors, a subsidiary under the life insurance company. We managed insurance company money, pension fund money, and I was the low man on the totem pole out of three. We were managing about $5 billion worth of real estate, and so I flew all over the country, negotiating joint venture agreements, looking at assets, buying and selling assets, leasing, capital improvements, you name it. So that's, I'd say, where I really cut my teeth outside the books. It was a great experience, and, if I had a wife and kids down there, I probably would have hung it up, but I didn't. And Des Moines was a little sleepier than I wanted. So went out to New York, went to and did my master's in real estate at Cornell. It's a 2-year dedicated program. Smaller class size, there are about 25 kids, and from all different walks of life, but very intelligent people and interesting people. I probably had no business being there, but my mentor at the time, Boyd Stouffer, who was at United Properties, had encouraged me to go there as he went through that program, and now I believe his son is, and helped me to get in. It's a great experience. Worked for related companies out of New York City, one of the largest real estate developers in New York City right now. They're doing the Hudson Yards redevelopment, which I think is the largest contiguous real estate development going on in New York City right now. Aggressive guys, good guys. They wanted me to go out to Texas and lead a charge, and my relationship at the time prevented me from doing that, so I stayed in the city and worked for a group called Emmis Asset Management Group, pension fund investment advisor. And we managed a ton of real estate around the Midwest. That's what I was focused on, but 7+ million square feet of retail primarily. We did some other asset classes, but and then about 3 years in the city, and I'm a guy who likes to get out and go hunt and fish and run up to the boundary waters, and that's about all I could take. So I said, see you later, and came back, and I went to work over at Excelsior Group, actually, Kim Culp. He's a great guy. I really enjoyed working with those guys. I have nothing but the best things to say about those guys. But I figured this was probably my opportunity with this new start and fresh start coming back to do what I've always wanted to do and start my own company. So that's when I split off and started Northland Real Estate Group and focused on opportunistic and value-add development.
Awesome. Any geographic area you guys are kind of specifying?
Honestly, I've and this is by design. I don't love managing people, and so I keep the size of my shop pretty low. So I've been able to find I don't know if it's been luck or because I'm good, but been able to find some really cool projects, and again, just been inundated with opportunities here locally where I haven't really had to travel.
Sure. Good. So kind of intermetro, 7-county metro, primarily.
Even though we do have a project in Lindstrom, Minnesota right now, a fully approved 92-unit multifamily project with a 4,500-foot restaurant and marina on the Chisago Chain of Lakes
Really?
that we just got our
Interesting.
TIF approval on.
So do you stay in these deals, or, run me through? So a deal kind of falls on your lap, start me with, how do you go out and kind of identify opportunities? Is that through networking, or what's your process for kind of identifying the opportunities? And then how do you typically evaluate them and figure out which ones that go, no go?
I'll answer that first question, and that's, do I typically stay involved in them? I know some of these guys like to play, the get in, get out, and I know they know that end asset is something they would probably not want to own long term. They just want to clip the margin. For me, every asset that I look at, I need to be comfortable owning it long term, and that's what I go into it with. I don't like playing musical chairs because I've seen the rug get pulled, and it's not a position I would want to be in, especially if it's my money at risk or my investors. So with that in mind, I structure it, and I approach every deal that I'm going to be in long term. There have been situations where, it's made more sense to exit, where someone sees more value than I see, or when the equity partner or entity, when their entity is jeopardized by, for instance, a for-profit company coming in and partnering alongside them. We ran into that in one of our senior deals, where we found, I found, my equity partner was a nonprofit group, and being nonprofit, they're tax exempt. Partnering with a for-profit company jeopardizes that tax exemption. So the only way around that would have been to invest under subordinate B bonds, but the true structure behind that, if you read the fine print, is not very attractive as a for-profit developer and investor. So
Sure.
we amicably parted ways at that point.
Everything's for sale at a certain price, right?
Yeah, that one kind of killed me because I truly, those are the lakes at Stillwater. It's a 3-phase, 240-unit senior housing continuum care community. It's on about 70 acres. We have miles of walking trails, lake access. You have everything from twin and quad villas down by the water to active adult, age-restricted apartments to a main lodge where you have the higher acuity events and activity center. And with that project, it's like, let's put ourselves in their shoes. When we get there someday, where do we want to retire? And I love being outdoors. I love going up north. I get excited about it, and that's really where I'd want to retire. So that's what this project was essentially putting the Maddens here closer to the cities in Stillwater.
Sure.
So that's why it's called The Lodge, right? Mm-hmm. And we're going to Maddens. We're going to camp. We're going up north, and that's where I'd want to retire. Not in a facility, not jammed on a highway somewhere counting cars. Truly in nature. We have deer running everywhere, outdoor workout stations. The other thing with those senior projects that I typically get involved in, I think the number one attributing factor to longevity and happiness is getting out and being active and finding areas that entice people to do that. So that was the whole precipice for focusing my energy on that project. Because when I picked it up, it was a broken 6.5-acre deal right on the highway there, and spent the next 6 months assembling 65 more acres, and then getting the multi-phase project approved, but pushing it back into nature and integrating all the trails. So it truly is a transition community.
That's
and they
awesome.
can progress as their needs merit.
It brings a new aspect into how much excitement you have around what you're actually working on. Mm-hmm. That's really cool.
Mm-hmm. Thanks.
So how many deals you got going right now, Brian? Do you ever sleep?
You know, I had great jobs. I got paid very well. People killed each other trying to get them. But in the end, you know, in your gut, I never felt passionate about what I was doing until I jumped. Then I started my own company, and I don't know if it was fear of failure or if it was endless opportunity, but I was fired up, and it hasn't stopped since. So, you know, my family, my girlfriend, they'll be the first to say that it's a double-edged sword because it doesn't stop, you know, and I haven't found a way to turn it off, but I love what I do, and it's very invigorating to have endless opportunity out there, and every deal, you know, it's your slate.
Sure. Mm-hmm. No, I'm sure every deal kind of has its own story about how it progressed, right? These things kind of take on a life of their own, has been my experience. You know, maybe pick one or two of the deals, and can you tell us a story about how do you start by mining data and figuring out, you know, where the opportunities are in a, you know, supply and demand for a particular asset, or how do you kind of work in maybe some of the psychographics, like, you know, people maybe don't want to drive 3 hours up to Brainerd. They want something a little bit closer. Talk to me about how you maybe are using data or stuff like that to maybe start on the front end.
That's a good question. If I had more time and if I were a more intelligent man, I'd probably start there. The reality is I don't. Situation comes up and crosses my lap, and first I assess, you know, is there an opportunity for a deal here? Is this fully marketed deal and fully marketed in a way where everyone else is looking at it the same? If it is, okay, that goes in one bucket. Is this off-market deal and truly off-market and unique opportunity? Then I'll put more time into it.
So what I'm hearing from you is a deal comes across your lap, and then you kind of do a market study or an analysis on that particular subject, property, or site.
I guess before I do an analysis, I ask myself, is there an opportunity for a deal here? I think we have a very efficient market right now, and it's, I mean, no news to you or anyone. It's hard to find a good deal out there, especially one that warrants returns attractive enough to want to put your money in. Not to mention the weird construction cost dilemma we're in right now, but just the market itself. I mean, there's a lot of money out there and a lot of people chasing deals, and especially those people that are investing other people's money. You know, it's pretty easy to spend other people's money in a lot of cases. And, you know, for me, it's my family and friends and individuals where, you know, I look at it just like my money. So I'm very cautious with how I spend it and what I spend it on and when I spend it. But first, it needs to have an opportunity for a deal. And if it does, then I'll dive deeper into it and validate with market demand studies, et cetera, and underwriting. But if the right deal or if a good opportunity comes across and it truly ends up being a good deal, it's not going to be around very long. You know that. Yep. So you have to move pretty quickly. And I think a lot of people forget to use their gut. You know, and a lot of people talk about doing deals and they talk about diving in, but that is kind of what ends up happening is they talk too much and they don't do enough.
Yeah.
You know.
It's always that double-edged sword.
At the end of the day, you know, it resonates that it was a productive day talking about doing deals, you know, but at the end of the day, it really doesn't matter unless you do it. Right or wrong, I've tried to do more and talk less. And if it feels right and your gut's telling you it's right and market should support it considering everything else is equal, I mean, we all have a pretty good pulse on where we should buy based on units we anticipate to put in there or relative market comps. You got to act. So assuming I can then get control, then the rest is validation.
Well, I was going to say, so Mike was just down in Florida doing his second, I think, course 2 for CCIM courses, right? And one of the big things that he took away was primary research. Should we talk about that?
Yeah, we could get into that. I want to dive a little bit deeper into this, identifying if it's an opportunity or not. So does that starts at the high level of making sure that there's an opportunity to convert some use, or there's hair on the deal, or are you actually getting into some kind of financial analysis? Like, walk me through what your definition of making sure that there's an opportunity there actually means.
Making sure there's an opportunity is beyond finances altogether. First, there needs to be an opportunity, and by what I mean by that is whether they're in capital distress, whether they can't make the bank payments anymore, their equity partner wants out, they're having management issues, one of them moves to Florida and doesn't want to be involved anymore, they're an out-of-state owner and don't fully understand the local market, or there's some other hardship, right? For me, it first needs to smell right that there is an opportunity or could be. The second piece is financial validation. I mean, it needs to pass the smell test relative to other projects that you've made work or that are working and that banks are lending on. So, if you look at a raw piece of dirt and you can put 50 units, you can put whatever price tag you want per unit on the land basis relative to what you think you can get rents there, and quickly assess if then that validates your assumption or not. And just because there could be a deal there doesn't mean that there is. There's often a pretty big disconnect between landowners' assumption of their value and the true intrinsic value. I think a lot of landowners are holding on to what their neighbor got up the road on the hard corner because a bank wanted to be there or something like that. But, there are a lot of deals that you look at that don't ever come to fruition, and that's just part of the game we play in. You got to continue to pound them out and keep chasing, and the ones that truly do have intrinsic need do percolate.
So am I correct in hearing you on the first part is that you have a motivated seller? Some kind of problem that they're experiencing, so they would be motivated for you to be able to make the deal work?
Yes. And or the market is looking at the product type differently than I'm looking at it.
Tell me about that.
So a deal is marketed as office. Office market's a little softer than housing. Can I convert that to residential? Can I convert that to senior?
Yeah, so highest and best use.
That's right.
So you said you had a big background in that. Tell me about that. How do you actually look at a property and do a quick analysis of what you think the highest and best use is going to be?
Depending on where it is, I know there are some that are more bullish on office than I am. It's tough for me to make any office deals work these days. I guess unless you're Rich packing in, getting. Sorry, Rich.
We'll edit that out.
Yeah. And God bless them. It's tough for me to focus on that with a straight face, knowing I could go residential. That is a much easier sell and has a more proven market with less vacancy, obviously, and higher rents per square foot.
So you're hot on residential conversions from office right now?
No, I mean I wouldn't just say that. I'm just hot in general on residential senior housing, even though senior housing projects are popping up everywhere. But again, I think my company or my vision has slightly an advantage because we're a little bit more choosy with where people really want to live. I see a lot of these facilities getting built out of necessity and utility versus desire, right? These are the places I get involved in and help to develop are places that I would want to go live, not I have to go live. A lot of these places are being developed where you put mom in a home, and you just put her there because it's the only thing there and it's the only one with vacancy. But I'm trying to create a product type where people actually want to live and make the jump or make the plunge, sell their home, and they don't want maintenance anymore. And they don't necessarily need the extra assistance, but it's comforting knowing it's close by. And our communities try and incorporate that progression if it ever comes.
Based on, your cost of funds and how you typically structure your deals, what kind of multiple? I mean, how do you go about doing a quick analysis on whether it's worthy of starting to invest some money in, say, market studies and things like that? What kind of numbers do you need? Is there a % increase on your kind of basis that you're looking for? Can you tell me about kind of high-level numbers for the sniff test?
Yeah, in complete transparency, it's typically my company's money on the front end for due diligence, entitlement work. What I try and do for my investors is put a clear picture together, not only what is in demand, but what we can get approved. Because as you know, the riskiest dollars are the early ones. So I have not asked my investors to participate in that. Some have expressed interest in wanting to. It's just as a developer and as a steward of their funds, I feel it's prudent for me to prove that we have an approvable and product type that will be successful before I ask for them. So, does that answer the question?
Yeah, that answers part of it. The other part of it is like, what kind of percentage increase in value do you need for you to get excited about moving forward on a project?
I'm not traditionally a multiple based investor, even though, if you can't pull out at least double your investment, it's probably not worth it, depending on the time span. I'm not so much an IRR-driven investor. I worked, as I said, for the larger shops where you're forecasting 5, 10, 15 years out, and you end up going with a blended average of what caps have been, over 40 years. But none of us know. None of us know
Right.
what it's going to be in 5 years, 10 years.
Mm-hmm. Is there a metric that you do use?
Cash on cash.
Cash on cash.
Mm-hmm. So as it relates to my company's money, investing that on the front end, that's just, you got to pay to play. So I don't have any metric on what I expect to return on that, or, hey, I can double that for my developer fee or anything like that. I don't. It's would this be a prudent investment if it comes to fruition for my investors? Yes, then I spend my money on it. For my investors, I'd say at least my pool of investors, cash on cash is most important. So some of them are more keen on, after it's stabilized, recapitalizing, whether that's through a refi or a sale, to recoup some of that. And some of them, they don't need the extra money. So it's just mailbox money, as everyone likes to call it. But that's what's most important, and that kind of falls in line with my original statement that I don't approach any of these deals hoping that I can sell them. We're owning these long term, and these are the cash-on-cash numbers that we're projecting, and that's an attractive investment and a stable asset that'll coincide with my goals and my investors' goals.
That's good. It's good to hear that they're, that you're taking your fiduciary responsibilities as a steward of their money seriously, and that's your reputation as well. So let's talk a little bit about, a deal. Now, we don't have to go into specifics, and we're not giving investment advice here. But let's just talk high level how you might structure a potential deal, what kind of joint venture structure that might look at. And then what is your role? Are you playing the role of developer, and then you're also participating in some of the investment side? And then are you managing these things as an ongoing project?
Let's just take the Seastead's Carpet redevelopment down in Lower Town, St. Paul, right next to the new Saint Stadium and the Farmers Market. That project was had quite the runway on it due to the historic tax credit nature that we pursued. With the historic tax credits, you have to essentially go all the way through construction drawings. You have nine months. I've heard people can get it done. I've never seen it. So you have about a year. So there's a lot of upfront risk, and you have zero certainty that the project will be approved, but you're on the hook for paying for those construction drawings, whether or not you get approved for your historic tax credits or not. So it's a lot of exposure, but that building was worth the investment. It's a beautiful red brick building, 30,000 foot, iconic building on the corner of 6th Street and Wall Street in Lowertown over there. And I was working with Seasteads, the owner of Seasteads, great guy. He was patient with me. You know, it's hard. It's one thing to understand the process that you have to go through. It's another thing for, as someone that's been in real estate for 15, 20 years. But it's another thing to convince landowners of the process you have to go through. Because some of them want a value that currently doesn't exist as a vacant building.
I see it all the time.
We all do. So the difficulty is convincing those landowners that I understand you want this inflated value. The only way for me to justify paying that is if these other pieces fall into place. And that's kind of what I was getting at of thinking outside the box. That touches on that point, and that's where these historic tax credits come in. We all know we want to own the iconic, corner building that faces the high visibility roads, but you're going to have to pay for it. This is a way I've justified and found a way to afford paying for it, was through these subsidies. Now it's more exposure, it's more time, it's a lot of coaching the property owners on the process you have to go through in order to justify paying that. But it ultimately worked. And it's going to be a very successful project. We have great tenancy on the first level with Chuck and Don's Pet Supplies and Wellhaven Pet Clinic. And I think it'll be just a great complementary use with apartments above it. In structuring that joint venture relationship, I called Stu Ackerberg. He's also a Badger. Go Bucky.
Team Wisconsin.
Yeah, right.
And I knew he had chips down on another deal over there. And, they are retail heavy, they understand the market and understand the apartment market. And after I secured those leases, I called Stu and said, this is a perfect fit for us to do a deal together. Because I knew Stu from before through the Madison relationship, and I have utmost respect for Stu. Look at him like a mentor. He's a great person, and he truly does. He pulled me aside and said, I truly do want to see you succeed, and I sincerely believe it. So this was a neat opportunity for us to structure a deal together where we can build our own relationship, especially professionally. And I like the back office support that his team brought. That's not an area that I get excited about on the management side and the operations and that back office support. And for Stu, that is of utmost importance on top of what he's already built. And I felt it was very complimentary and have enjoyed working with him and his team.
Good.
Construction costs are expensive, but that's another piece with historic rehabs. It's sometimes a misconception, I think, that individuals think you automatically get 40% of QRE's, qualified rehabilitation expenses, back. And I think the true net is less than that, because the HBC and SHPO, the governing authorities behind protecting this significant historic architecture, mandate that you do the rehabilitation a certain way. And that certain way and those different intricacies add cost. In addition, there's a lot of risk associated with the general contractor making sure that they complete that rehabilitation specifically as planned. And there can't be hiccups. They can't go cowboy and do it their own way, because then you're at jeopardy of losing those tax credits come the final walkthrough. So They put in, I think, some save your money. Like, they don't know what they're going to find when they open up certain walls, and it seems like everyone hears historic and then adds 10%. So I don't know what that true net is.
Sure.
But it's somewhere between 30 and 40, but it's not 40.
Sure. Yeah, not all portions of the project qualify for the QREs
Exactly.
as well, right? You got fixtures and furniture.
I'm talking
and that
of
kind
just
stuff.
QREs.
Yeah, of QREs. So you brought in some investors. Are you able to share maybe at a higher level on a typical project? It doesn't have to be that specific one. Are you guys doing like a equity waterfall type of structure, or what kind of typical structure is your default setting for a development that you might be doing? And are you guys putting in 5-10%, and then you get some kind of promote as you deliver specific returns? Can you talk to me about that a little bit?
Sure. So on a typical deal, under whatever Northland specific property entity is formed, that'll be Northland as the developer, and then they'll have their investors. So Northland's the general partner, investors limited partner. Northland will put anywhere from 5% to 50%, depending on the opportunity. The limited partners will put in the residual. There is a waterfall that I typically set up. The promote ranges based on the risk of the investment, and I think the nature of the investment, what it can sustain. Sometimes projects just can't sustain, a 10 pref or something like that.
Sure.
And in those instances, it doesn't mean it's a bad deal. But you be transparent with your investors. You explain why, considering all the alternatives, why it's still a good investment or not. And, ultimately it's their choice whether they want to participate. But we've done plenty of deals where that pref is below 8%. Typically, I see them range from 7 to 10%, I'd say, on the pref side. And then above that, there's a waterfall promote after their capital is repaid and their preferred return.
Okay. So like 8 to 10 pref, and then as you hit those numbers.
Right.
So you're just doing like pari passu on the front end then?
Yes.
Okay.
Yep.
Up until the kind of hurdle rate there. For those of you that are listening, by the way, if this sounds like ancient gibberish, you can check out our video library, and we have an entire 1-hour video on structuring the capital stack. So make sure you go check that out at creative.realestate.
Yeah, so you're exactly right. I think the general rationale behind that is you give me cash, I give you a preferred return higher than any other traditional investment you could find. And so long as I return your cash and that higher rate of return promote or preferred return, then we all should be able to participate on higher levels after that.
Have you ran into issues? I'm assuming you're going to getting renovation financing on these. Are you doing rental loans?
Yeah, we're doing construction loans that roll to perm.
Kind of LTVs you getting on that? 70, 75, 80?
Depending on how secure the borrower is, anywhere between that range.
What I've ran into with the lenders, where even if I have limited partners, if they're putting in more than, say, 20% of the capital that they're trying to get them to sign on debt, but ultimately, inherently, a limited partner shouldn't be exposed for more than their portion. What are you guys finding?
I'd agree. I mean, the banks, put yourself in their shoes, watching out for their shareholders. They'll try and get as much security as they can, as they should, because that's where their fiduciary responsibility lies. As general partners, we need to protect our investors and try and limit that exposure as much as possible. And if they are exposed, compensate them for it, or make sure that they're fully aware of the risk and the returns reflect that.
Are you setting these up as multi-member limited liability partnerships or LLCs?
LLCs.
LLCs, okay. Just a multi-member LLC.
Mm-hmm.
And then you'll have like Class A, Class B membership units.
Yep.
Okay, good. So that's kind of a cool structure. When do you actually? So you kind of do all the front end due diligence and get the thing ready and teed up, and then you put together some kind of investor packet and bring people in at that point.
Yeah, depending on the structure, it all looks different. Depending on the size of the deal, the nature of the deal, and the capital needed. But again, you need to qualify your investors, which I've already done, and depending on the appetite and how much capital is needed, kind of depends on how you go out and look for it or who you use to source it.
Sure. And I'm assuming you have some kind of network. Are you primarily just going back to your same network, or are you using some kind of sourcing?
Primarily, as we get into some of these larger deals, I've been fortunate enough to not have to do too large, too formal of a dog and pony show based on my connections. But I do see that progressing, where we'd probably go down that road to just make it more streamlined.
Can you tell me, is there a particular traits that you look for in a limited partner?
Yeah. Deep pockets and absentee. No, limited partner. It's very helpful when your limited partner understands real estate because that's less hand-holding. Sometimes people are like, well, hey, they got a boatload of money and they don't know where to put it. Sometimes if they don't know real estate, at least selfishly, that can be very time-consuming and can also be unnerving for them, right? And some of these deals move quicker than the risk tolerance some of those individuals are willing to take. So understanding of the real estate market and the investment world before jumping into one of those, depth, liquidity. And it also helps, with how well connected they are too. I've had many of these relationships multiply based on their individual pool of friends and investor buddies. They've invested on businesses, real estate, other ventures, and I've definitely have had some of those relationships multiply.
Especially when you're paying the returns, right?
Yeah, exactly. Well, that's also one thing I try and do is make sure to send that check every quarter, regardless sometimes if the properties are producing, because they've taken a chance on you and your company and your vision, and I think it's prudent to make sure that they know you recognize and appreciate it, and we'll take that chance back on them.
Yeah,
That's
absolutely.
really smart.
So I want to wrap up with a non-real estate kind of related question here, and then we can maybe answer a couple of your questions and then kind of have a closeout. If you had one day left to live, how would you spend it?
That's a heavy question.
Only the easy ones for you.
If it were summertime and the mosquitoes weren't bad, I'd probably want to go up to the Boundary Waters. Just chill out, paddle around,
Nice.
catch a couple walleyes, have a good fish fry, watch the northern lights, drink a little whiskey by the fire, and fall asleep.
My man.
Yeah.
Good. Well, you're truly a visionary, Brian. You're somebody I look up to as kind of a mentor and somebody who's
Thanks, man.
much farther along than me. And I really feel grateful and blessed that you've joined us here today. And
Thanks for the invite.
I have a little bit of time here. If you have any specific questions for us, we're happy to make sure this isn't a one-sided data sharing moment here.
After we toured your project with down there in Lower Town, kind of talked through, I know you had said you were looking at crowdfunding, which congratulations, by the way, on getting done. It's a space that I don't fully know and understand, and I guess maybe getting some insight on that would be helpful for me.
Don't do it.
Well, it seemed to happen pretty quickly.
Yeah, I think we got it approved fairly quickly. I'm certainly not a crowdfunding expert by any measure. Really, it was Zach Robbins over at Messerly and Kramer. If you want to do crowdfunding, he's the guy I would recommend. He basically did the whole private placement memorandum and all that stuff, and then it was hosted on the platform that David Duccini offers. You guys can find that at sppx.io. It's the Silicon Prairie Portal and Exchange. So,
was that an expensive process?
It's not actually. So, what we did is there's a few exclusions in Minnesota where you can actually do a private placement memorandum, but not have a $50,000 offering. It ran about $10,000, I want to say, plus another $5,000 for the portal.
Mm-hmm.
So it's certainly not cheap. And we only raised $500,000 or so, give or take.
But it closed out pretty quickly, didn't it?
It closed out pretty quick, and we were able to successfully raise it. But this idea of if you build it, they will come. You'd think and you see all the opportunity in these investments, and you think how would somebody not want to invest in this? And that it's not how it really comes down. You're going out there and basically doing the same grinding you would be doing, securing other limited partners. So the reason I did it is we had other money partners who were basically going to step up and do some kind of IRR waterfall. There's two reasons I did it. One is to maintain control over my project. So we actually structured ours as a mezzanine debt piece and didn't give up any of the equity. So that's the biggest advantage for us. And then you look at the partners that we brought in, they were, a lot of them, friends and family, and I'm able to deliver them an opportunity that they would never have an opportunity to invest in. So, I started looking at it. If you truly want to make your business about changing and impacting people's lives for the better, then you got to start thinking about how do you think like the small person and how can you help the small person get in. So in our particular offering, you're able to get in for as low as $10,000. So a lot of my investors were friends, family, and a few outsiders that had IRA or 401k money, and they were like, I'm just investing in what my company tells me to. And I actually taught them the process of how to roll that into a self-directed account and then invest that money into our portal, into our project. And, it's delivering returns that probably far exceed on a risk-adjusted basis what they're getting out there in the market.
What sort of returns do you have to?
Well, I'd have to kill you if I told you that. No, it's all public data. So the way we structured ours was mezzanine debt at 12 or 10 to 13%.
10 to 13. And do they have security in the asset?
They actually did not have security in the asset directly. What they had is a security interest in the entity that owns the asset. So it was like a convertible membership unit if for some reason. And then I also had to sign a personal guarantee on that mezzanine debt along with a corporate guarantee.
Got it.
The reason we structured it that way, Brian, originally I was going to do it as an equity deal. Yep. And as you know, on these historic tax credits, they get distributed pro rata to the ownership.
Yep.
And so what we were going to have is a situation where you had a lot of small owners that had 2, 3, 4% equity in this entity, and they were getting tax credits that could only be used to offset passive real estate gains, but they don't own any real estate. So they would have basically been unable to use their pro rata share of these tax credits that were being distributed to them. Right. And so that's why we did it the way that we did it.
Why did you choose not to sell those tax credits?
One, we didn't need to. I could have sold the state tax credits and not done any of the mezz debt funding at all. I just thought it would be cool to do it. That's why we did it. It wasn't because we needed to do it. I just wanted to do something different. So we were able to do kind of the first crowdfund for commercial real estate in Minnesota. And we like to think creatively. How can we get a deal done the way nobody else is doing? Because it seems like everybody's doing, hey, we're going to pay, 10% pref, and then after that it's a 50-50 split, or some people do the waterfall model.
Right.
And that's how I'm seeing the majority of deals being done. And I was like, well, how can we actually maintain all the equity in the project, but still give people access to an opportunity they wouldn't otherwise have? And it just seems like a win-win across the board. I was starting to find a lot of the private lenders that we're using for these projects really start dictating and overstepping their boundaries on maybe some of the management and how things need to go on capital calls and stuff like that when it comes down to the rubber hitting the road.
Mm-hmm. So does any unpaid, that mezz interest, does any unpaid interest get accrued? Or
It's
how does that
all
work?
it's all accrued until the tax credits are paid, and when I receive the state refund, instead of selling it at maybe a 6% haircut, we'll still do like probably going to do the PAM structure, tax advantage structure, but we just won't take a haircut on it. I'll just actually take it, and since it's refundable, I'll use that money to pay off the mezz debt. It should work out quite nicely because I think our QREs are projected to be about $3 million, give or take.
Mm-hmm.
So you figure 600, and I think we raised 525. So there should be enough there to pay that off, and then we'll just take the federal credits over the 5 years through our development group.
Cool. And you can prepay that mezz debt at any point?
Yep, prepayable at any point. The note goes for 5 years. So if for some reason I can't refinance them, or for some reason we mess up the historic tax credit renovation and lose the tax credits, then, I'll just have to refi concurrent with the term on my primary note.
Got it. So you just prepay with whatever accrued interest was.
That's exactly it. Now, it says that if I have debt service coverage of over 1, that beyond what the banks beyond the bank's requirement, I think they're setting it at 1.2, then I have to distribute earnings quarterly.
Got it. Cool. Thanks for sharing.
Yeah. A big reason we're doing this podcast is to really open the book. I know when I got into this industry, a lot of people hold their playbook tight to their chest, and they really don't want to disclose some of those really nitty-gritty details that you're only getting behind closed doors. And so this is just to kind of shed light on the industry. And I think people really, really make it overcomplicated. Nobody wants to lay their cards down on the table because they're afraid of creating competition. And we want to just kind of change that theme in the industry and really give some of the behind the scenes knowledge that only the best of the best have to the general public, because our purpose is not to do more deals, it's to improve more lives.
Cool. Good mission.
Well, I appreciate you having you on the show here, and James for joining us with a couple of questions.
Absolutely.
And
Thanks for the invite.
Brian.
if they want more information on you or your group, where would we send them?
I think an email would be just fine. That's Brian, Brian, at northlandregroup.com.
Awesome. Thanks for coming on the show, Brian.
You got it, Mike. Thanks for having me.
Thank you for listening to our show, Creative Commercial. Head over to our website at creative.realestate or find us wherever you listen to podcasts. And please, if you like the show, leave us a review. It really helps us out.